U.S. interest rate update. I know we're a week or so out from the March Fed meeting, which will be super interesting. Still not anything likely to happen in terms of action at that meeting. But this, Glenn, is a huge one in terms of you might see a massive move in interest rate markets and forex markets, and then, of course, all of the second and third tier markets like your equities, your metals, and other commodities across the board, on what's going to happen in the next Fed meetings. We see this all the time where it's like, if you go back and look at the data historically, which we do all the time, and say, okay, well, these were the meetings where they actually cut or they actually hiked. You might look at the price action around them and say, I don't see a lot there. Or when they cut, the US dollar on that day actually saw a little bit of a bid.
Right.
And why isn't it correlated? Because the Fed of the last, really, as you and I have been trading the last 5 to 10 years, has been super choreographed going into their action. Right. But it's those meetings where, nothing's expected to happen, but Powell comes out and says something like, we're definitely going to hike, 2 times this year, maybe more. Something like that happens, and then all the markets shift for the rest of the year.
Yeah, and you bring up a good point that we might get a little more excitement this time. We're getting a dot plot, aren't we?
Yeah, I think this is supposed to be the projections and everything.
And those, it's kind of darts on a board, what have you. But this one might have a little more expectation into it because, as we'll talk about, markets guessing a lot where things will be if the Fed comes out with this dot plot of future rate expectations and confirms or denies what everyone's kind of thinking. We could see some shakeup off that.
Yeah, and the market definitely thinking more cuts. But let's get to the historical action. The Fed has cut rates from 5.5% down to 4.5% in the last year as inflation has cooled. Now, inflation is still, and I believe we have some inflation data in the U.S. coming out this week ahead of this March FOMC. Inflation is not at 2% yet. That's where they want it. But it does seem like we're in the scenario of it's close enough. We're not talking about it so much.
Right.
The market seems more worried or at least looking at the potential for a U.S. economic slowdown, and that's stoking these cuts as opposed to a few months ago, Glenn, it was, inflation has moved from 6, 7, 8, 9%, whatever metric you're looking at, down to 2, 2.5, 3%, whatever metric you're looking at. And so these rates should normalize lower so that the real rate of interest is only, 100 bips above that inflation rate. Now it's we need to cut because the U.S. economy is slowing down.
Right. And you make a good point that we've gotten inflation down to around 3%. It's stayed there. Maybe it's been a little stickier than people like, but then you turn to what we're looking at right now, where our interest rates still at 4.5% is sufficiently restrictive, as the Fed believes, and is still high historically, even though we're coming down from 5.5%. With these rates staying where it is, that gives the Fed leeway to say we can stop, we can keep going until we get some of those growth scares.
Not the same as, 5 to 10 years ago, where it's interest rates are 0 to 1.5%, and the U.S. economy has had a bad couple of months. Where do we go from here? So, coming down from 4.5% or what was 5.5% last year, maybe a little bit easier. Here's what the market is looking at in 2025 for the last meeting of the year. Market now expecting less than a 2% chance of no cuts for the remainder of the year, and that was well above 2%. I think it was closer to 10%, maybe even higher at certain points this year, which you might say, well, Frank, that's still not a big chance, but it's relatively significant of no cuts this year, just a couple of months ago to start the year. Now looking at less than 2% chance of no cuts this year and a greater than 50% chance, Glenn, of 70 bips or lower than where we are. And it'll be really interesting to see now the distribution trading between 100 bips and lower, and there's some tail risk of maybe getting down to 3%, but there's still a good chunk of chance in the 1 or 2 cuts for this year.
Yeah, and you bring up a good point with the no cuts. Yeah, that percentage hasn't changed a ton, but where we are seeing the most movement is that 50% chance. It was looking like, if we're looking at the bars on the right, it was all the percentages were in those 1 to 2 cuts. Now the center of the distribution completely shifted.
Yeah, with a chance of getting down to, I mean, it's only 4%, 4.5%, but an outside chance of maybe 3% interest rates by the end of the year. And so looking at the dollar price action around this, no coincidence that we've seen dollar downside from the start of the year, where there was a 76% chance, very high likelihood of just 50 bips or less in cuts. And now there's less than a 50% chance of just that 50 bips or less in cuts, coinciding with this dollar falling multiple percentage points against the yen, against the euro, against the pound since the start of the year. Here's where I want to end, though, Glenn. When is the next cut expected? Not expected for March, although the chances are now 5 to 10% that they do come out and cut. I think the market is still not really looking at that with any likelihood. Where the likelihood does get greater than 50% of a cut is in June of this year.
Which is earlier than we've seen in recent months, and that gives a lot of validation to the narrative that multiple 3-4 cuts could come this year.
Yeah.
Because if the first one isn't until September, then you're kind of back against the wall, have to cut every meeting. You cut in June, maybe you even cut in May, and then you have, 4 or 5 meetings to do 1, 2, 3 cuts, or even wait and then a jumbo cut like we saw last year.
And what's been the kind of elephant in the room, the whole year-to-date trading has been the fact that major economies like the Euro area, like the UK, like New Zealand, Australia, a lot of different parts of the world, Canada as well, close to the U.S. geographically and by trade, have been cutting consistently. And we've been kind of saying, is the U.S. siloed off from this, or are they just the last to fall into this trend? And so it does become, okay, maybe they're not cutting till June, but then does it become, cut, 2, 3, 4 cuts in a row like it's been in these other central banks? Will be interesting to see. But there's your update going into the March Fed meeting.